As we begin 2026, investors are forced to reassess geopolitical risk. That's after a dramatic escalation in Venezuela. The U.S. announcing it's going to run the country in the at least near term, following the removal of its leader over the weekend. As the key question now for the market is whether this remains a headline risk or whether it becomes something more consequential. Joining us now to break it all down and give us his thoughts on the year ahead is Christian Medeiros, Vice President, Portfolio Manager, Asset Allocation at TD Asset Management. Christian, welcome to the first show of the year, and we thought it might be one of those sleepy look-aheads. Obviously, we have a lot of stuff to dig into. Let's start with Venezuela, the market reaction. Right now, we got green on the screen on both sides of the border. What do you make of it all?
Yeah, great to be back. Happy New Year. When we think about a geopolitical event, when we see a headline risk, the checklist I like to run through is, does it affect global growth? Is that flashpoint somewhere where it's going to affect major supply chains, major resources, or is it a major geopolitical choke point? If those aren't true, then it tends to be something that won't matter as much for broad markets. It's something that the market will probably fade in the coming days. So I think that's what we're mostly seeing on this risk. However, there are key areas, which we'll talk about later in the show, like Canadian energy, where there is some effects, Canada-US relations, where I think there'll be some effects. But for the broad equity markets, even broad energy markets, I think it's mostly going to be a non-event.
That's interesting, right? Because this has been framed in the early innings as an oil story in terms of what happened in Venezuela. They haven't produced meaningfully in years, though. Global supply remains oversupply. But when you put all those pieces together, how does it start to look near and longer term?
Yeah, so for the energy markets, Venezuela produces about 900,000 barrels a day. The global energy market's in excess of 100 million. So this is less than 1% of daily production. And even at their peak, multiple decades ago at this point, they were producing about 2-3 million a day. So still not super material in the context of today's energy markets. And it would take them years now, just given there's been so much decay of infrastructure, corruption, mismanagement. It would take them 5-10 years to get back up to those previous production levels. So even with the regime change, if you will, the amount of money it will take, the amount of time it will take to get them back to a high level of production in a way that would materially impact global oil markets will take some time.
All right, so let's talk about, these are early innings, right? We don't know what's going to happen, what's going to transpire going forward. Could there be a power vacuum, an insurgency, regional conflicts? How do we start to think about this in terms of risk?
When we think of past cases of regime change in many countries around the world throughout history, when you go through a regime change where you keep a lot of the political architecture and military architecture in place and the institutions don't change, that tends to be a fairly stable outcome, at least in the short term, because you don't result in a power vacuum and fighting between residual factions left within the country. So where things currently stand, it's very, very early days, but the former vice president has now is now the leader of the country. She seems to be wanting to work with the U.S., has tacit U.S. support. And there hasn't been a material change in the balance of power within Venezuela. So maybe not the best option from a moral or democratic standpoint, but at least from a stability standpoint, this is probably one of the more stable outcomes that we could have expected. And so we wouldn't expect, at least in the near term, for there to be instability, civil war, or even for U.S. boots to be required on the ground.
Now, obviously, before we headed into the holidays, we knew you were going to be the first guest for the first show of the year. We had a conversation before that. We were already watching Venezuela and what had been happening in terms of the buildup. Now that we've actually had action on the other side of that, did anything in your thesis change? When you see the events of the weekend, you have to go through them, but you had a view heading into this.
Yeah, so heading into this, there's been several months now where the U.S. administration has been talking about Venezuela, concerns about narco trafficking, and then there's been also a large shift of U.S. military assets into the Gulf, including some of their most advanced aircraft carriers. And you tend not to do that in North America. You tend not to have your most advanced warships in the Gulf. It's a very safe region. So if you're going to have assets there, there's a decent chance you're going to use it. So there's a big expectation that something would happen on Venezuela over the next couple of months, and of course it did. I think the military operation was a lot more successful than anyone could have imagined, much more surgical, and didn't require wide-scale bombing or boots on the ground. So kind of that played out as expected. So I think it was only a matter of time, but I think the timing was one that took markets by surprise.
Now, of course, the question closer to home is what it could mean for demand for Canada's heavy crude longer term. You talked about the fact that the infrastructure is not in great shape there. There seems to be a reaction today in the market. Maybe it's a knee-jerk reaction. We're seeing the Canadian majors trade down on this. How should we start thinking about the Canadian story?
Yeah, so for Canada is where it's a lot more interesting. The reason why is the Venezuelan crude is predominantly heavy crude. So it's very similar to Alberta oil sands, if you will. They're quite similar kind of grades. And when we think about the U.S. Gulf refineries that import a lot of the Canadian crude to refine it, they're fine-tuned to use to refine heavy crude, which is what we're supplying them and what Venezuela used to supply them. So if Venezuelan Venezuela produces more, or if they reroute their existing production away from China and towards the U.S., this could mean more supply of heavy crude in the U.S., which might push down heavy crude prices, which is a negative for Canada. And the other thing it might do is also compete with Canadian barrels at Gulf refineries. So at the margin, it is competitive to Canada, but there are a lot of mitigating factors. First off, it's going to take a long time for Venezuela to boost production, as we mentioned. Secondly, Canada has pipelines directly to these refiners. It's a very stable political party. It's a very trustworthy supplier. And there's also a lot of other refineries and uses for Canadian crude around the U.S. that don't just go to the Gulf. So at the margin, it's negative for Canadian energy producers, but not catastrophically so. And when we take a step back at the TSX level or TSX Energy level, a lot of the bigger energy companies in Canada are either integrated or also have a lot of other business lines like natural gas or light crude. So they should be less affected by the heavy crude differential, if you will. And also, when we look at the TSX, energy is just not as big of a weight as it used to be. So in the TSX 60, as we're seeing today in the market reaction, the energy impact is quite minor.
Now, apart from this, a big event in the early innings of 2026, I know going forward you are constructive on this year on the markets. Talk to me about where that confidence is coming from.
Yeah, so when we look at Wall Street expectations, it's so interesting to start the year. Everyone has an outlook. Doesn't mean it's going to be correct, but it kind of gives you a sense of where consensus is. The current current consensus for these Wall Street prognosticators, if we take a survey across the board, almost all of them expect a higher equity year. Most of them expect high single to low double-digit returns. Their positive view, and I would share some of these, would be positive fiscal in the U.S. from One Big Beautiful Bill, positive fiscal around the world. Germany had a big package last year. Canada did. Japan is pushing positive fiscal. Accommodating monetary policy. Canada's cut to very low rates. U.S. is expected to cut more and could cut even more in the event of a more dovish Fed chair. So policy is broadly supportive. And then it also gives confidence, a lot of AI CapEx spending, which continues to be a trend going into this year, but also a hope that AI CapEx spending will lead to AI productivity for a lot of companies that aren't necessarily in the tech ecosystem. So these are a lot of the tailwinds that investors are positive about going into this year.
Any other big themes you're watching for this year that we should have our eyes on?
There's a few. I think let's talk about some things outside of the U.S. USMCA renegotiations is taking place this year. I still expect there to be a free trade agreement between Canada and the U.S. in some form by the end of the year, but it could be rocky. Trump could threaten to pull out at any time. And I do think that at the margin, what's happening in Venezuela does mean that there's a little bit of a rhetorical change in some of the negotiating leverage that Canada has with the U.S. as they find other sources of resources. That changes some of our negotiating leverage on materials that we're major exporters to the U.S. for. So the USMCA is a big one to watch for Canadian investors. Secondly, how dovish does the Fed get? People talk about Fed independence, but we also have data that's changing quite rapidly too. Inflation could come in lower than expected. Unemployment rate has been ticking up. We could actually get more cuts than the market's expecting. It's only expecting 2 cuts for next year from the Fed, so that's something to watch.
For this year.
For this year, sorry.
It's hard to get into 2026.
And then lastly, the path of fiscal, right? We had a huge announcement from Germany. How much of that flows through to growth? Big announcement in Canada. How quickly do we get infrastructure built? And then in the US, we're leading into a midterm election. What does that look like? Do we see policy changes? Do we see some incremental fiscal to help boost the Republican chances into the midterm? And then how does that midterm result look? If we do end up with a split house, what's possible to be accomplished in the last 2 years of the Trump presidency? So those are some of the main things I'm watching for this year, in addition to emerging markets, which I think are an interesting theme going forward, but maybe we don't have time for in the initial section.